Hey guys, it's Wes. I want to talk to you today about credit. I get a ton of credit questions, and it's very technical. It's like a new language. So I wasn't a great math student, and I'm certainly not a perfect student with credit, but I want to go over some of the key components that FICO looks for, and they're different credit scores. So you may see one credit bureau that shows you a score, and then another credit bureau. FICO is very heavily utilized by the mortgage company. In fact, the mortgage companies usually take the average of 2 to 3 scores, FICO, Experian, and another score. But let's talk about FICO and how it breaks down. The bottom line is very important. If your credit score is below 600, you need some work. If you get an email with someone offering to do a mortgage, if your credit score is at 580 or below, be careful. If it sounds too good to be true, it probably is. If I had below 600, I'd probably take a time out, talk to that mortgage person, and figure out what's hurting my score and come up with an action plan to improve that score. All right? Average credit score is 600 to 740. Not long ago, 620 was high enough to get a mortgage. With the Fed coming in buying some of the mortgage-backed securities, a lot of the mortgage companies are not anxious to do loans where the credit scores are in the low 600s. You can get a loan, but make sure you understand what the costs are to get that loan. 680 seems to be a number that resonates with a lot of lenders to give you a better rate, a better deal on your loan. But if you're 600 to 740, you're in the average score. If you're above 740, you are in great position. You have excellent credit and should be able to get the best terms on your mortgage application or your interest rate. But let's talk about the different parts of that FICO score, what they're looking for. 35% of your score is made up of your payment history. They want to see a history of payments on time, several accounts that are in good standing. Hopefully all your accounts are in good standing, but they want to look at history. You just can't open one new credit card account, pay it for 2 months, and expect to have over 740 credit scores. So 35% is payment history. 30% is your credit utilization. How are you using the credit? So on that, if you have a credit card that allows you to have a balance up to $5,000 and you are maxing out that credit card every month, not a good idea. That's going to lower your score. What I recommend for credit cards or monthly, smaller lines of credit, those kind of things, keep your monthly balance below half of what the allowable limit is. So if the credit card allows you to spend $5,000 or go up to $5,000 max, stay under $2,500 on the balance, and make sure you make at least the minimum payment every month. So stay under 50% of the debt limits that are allowable on cards. 15% length of credit history. This kind of ties into the payment history. How long have you had that credit? I've had many clients come in that have no credit. So they'll go and get a prepaid debit card. They have the utility bills in their name and they start paying them. And it takes a couple months to establish credit. But again, don't get carried away. Don't spend more than 50% on the credit limit. The other mix, 10%, new accounts, new credits. What you want to do is be careful. I've had some clients that are under contract, then they go to one of the furniture stores and sign up for a furniture loan. No payments, no interest for 6 months, and then they get this new furniture set. And then they go and they start this buying spree. Every inquiry you have on your credit, every mortgage company, DirecTV, new car, furniture store, all these things count. And if you get, I believe, more than 10 inquiries per year, it's going to drop your credit. So be careful when you start getting credit inquiries. If you are shopping for a mortgage, I recommend maybe 2, max 3 mortgage companies to talk to. If you go online and all of a sudden a company like LendingTree, no offense to LendingTree, they're a great company, but a lot of these online sites will shop your information, and all of a sudden you have 20 different lenders looking at your information, and they start calling you and asking to run your credit. That's not a good thing. You don't want but so many credit inquiries. But if you're talking to 2, maybe 3 mortgage lenders during the application process, that's fine. That's not going to hurt your credit. You're going to have to give them your information so that they can quote you their terms and rates. Some misnomers. Is it okay to run your own credit? Yes, you can run your own credit yourself as many times as you wish. It's not going to affect your credit. Mortgage debt. Questions: is it more hurtful on my credit to have a mortgage debt or credit card debt? Because the mortgage debt may be $300,000, the credit card debt is $30,000. You're better off to have the mortgage debt. So long as you pay that mortgage on time, you're going to be fine, than it is credit card debt. Okay. Cosign. Some people will say, look, I'm co-signed a car. It's not my car. It's his car, and he's not making the mortgage payments. It's his car, so I'm not worried about it. False. If your name is on anything with your spouse or partner, son or daughter, and you're accountable. If your name's on it and the payments aren't made, it's going to affect your credit. Paying off debt. I had a client a few years ago. They paid off $30,000 of credit card debt. We sold their house. They put $50,000 in their pocket, of which $30,000 they paid off the credit card debt. Sounds great? It was great. The problem was then they closed the accounts. Their credit dropped 20 points. So the key in that situation, pay off the credit card debt, cut up the credit card if you have to, but leave the accounts open, because when they closed the account, guess what they closed? The history. And as you remember, history is 35% of your score. So if you pay off the debt, leave the account open. Don't close the account in the near future. One of the videos last week was forbearance. A lot of the folks are not making their mortgage payment. Forbearance is a bad word. It shows you are not delinquent, but you chose to forbear and not pay your mortgage. That's going to stick with you 3 to 4 years. It's going to affect your ability to get a car loan, a home equity loan, or actually refinance. It goes on your report. I don't care what you're seeing on the media and what you're reading about. Everyone else is doing it. Don't do it. Bankruptcy. If you go to bankruptcy, that usually is going to hurt you, your ability to buy a home for 7 years. And lastly, short sale. If you short sell your property, you're at least doing something for the bank. You're taking care of the house and getting it sold, but you're asking the bank or multiple banks to forgive the debt. That will affect your credit 3 to 4 years and limit your ability to buy a home. So there's a lot of details here. I'd love your comments. Please subscribe, and we'll have more information and details on the market and credit in the future. Thanks for watching.